My pleasure, Michael. Thank you. Can you see the screen okay now?
Yes, I can.
Fantastic. Hello, everybody. I'm toying with some new screens and right now have a new 49-inch wraparound screen for my new home office. And one of the things that doesn't show up great on it sometimes is how the picture comes across for videos. So thanks for bearing with me as I tinker with some new technology, which in case other people are looking at it, so far so good. It's been pretty effective. With that, thank you, Fly. I think it's a great organization, what you guys are doing, Michael, and continuing to innovate and build and provide content and information for us all to be better educated, collaborate, and ultimately, hopefully, make better investment decisions and find better investment opportunities. With that, today I'm going to talk about the private credit markets and the lower middle market in particular, and then dive deeper and more granular into two different complementary strategies that Star Mountain has, one of which we call value-added non-sponsored lending, where in layman terms, we help private business owners find, structure, analyze, negotiate, and integrate acquisitions. And then we help them package and prepare their businesses, often to sell to a private equity firm or another business at the best value possible. The second thing we have is a division that purchases assets in that same end of the market where we believe we have our expertise in the lower middle market, looking for off-the-run opportunities to provide early liquidity to investors in direct assets, as well as lower middle market private credit and private equity funds. So we're a specialized firm specifically focused on addressing the challenges and opportunities with the objective of optimizing alpha for our clients in the US lower middle market. So with that as a quick overview, this is confidential information. And if any other questions, you can follow up with Michael after. Very brief background on myself. I've been investing in the US lower middle market now for nearly 20 years. Before that was an investment banker doing asset management M&A, both with asset management companies and insurance companies predominantly. And as a result of that, very fixed income, very credit oriented type of analysis and type of investing activity. Back 20 years ago, I identified trends that are probably nothing of a surprise to any of you. One is we have an aging demographic. Two is that there is a huge number of private businesses in the lower middle market. So if you think about that dynamic, that means you've got lots of business owners that need to do something at some point. Some businesses will give their businesses to the next generation. Many won't do that. Many are looking to sell their company. Many are looking to make an acquisition. And private business owners recognize that there is a large valuation arbitrage when you grow your business. So for example, and illustratively, if you can grow your business from 5 million of EBITDA to 15 million of EBITDA, you might increase your enterprise value or the multiple upon which an investor will pay for every dollar of EBITDA that you generate by 25% or more. You all know the valuations in the public markets today, so that drives perhaps a larger valuation arbitrage than ever in history. You also know the aging demographic. So there are perhaps more people motivated to do something than there ever has been. And 20 years ago, most of those trends were reasonably clear, as were the trends where the banks and other asset managers would continue to focus on larger companies for a lot of reasons. And so we pursued building a specialized business, Star Mountain Capital, which today, as Michael mentioned, we have approximately $1.5 billion in assets under management, and we have completed over 100 investments at Star Mountain. I'm very involved in the community. Some things on my bio here I won't get into, but you're welcome to read and happy to follow up with other folks later. We also run a foundation with Star Mountain Capital, helping support women, veterans, athletes, and others trying to transition their careers and build their careers, which is often quite challenging, particularly for driven, passionate people that don't have experience getting into the more for-profit world for the next phase of their careers, whether they were an Olympic athlete such as myself, or whether they were a veteran that's giving back to our country and so forth. And so we're excited and passionate about helping those people find high quality career opportunities within the lower middle market. So it's very much complementary. Let's talk a little bit about some of the macro trends. One of the things that I found over 20 years ago when doing asset management M&A was that if you could get the long-term trends right, that sure helped. And on the flip side, if you got them wrong, it was very difficult, no matter how talented or focused people were. If you had the macro trends wrong, that's tough. Growing up in northwestern Canada, it was particularly obvious in the oil and gas sectors. You see the volatility, you see the challenges, and no matter how hard people would work and how strategic they would be, if that price of oil dropped below X amount for more than X number of months or quarters, there was really nothing you could almost do. The businesses would just go under. And so at Star Mountain, we really focus on avoiding those type of risks and focused on finding and identifying the key macro trends so that we're executing against a market opportunity that we believe exists. And then it really comes down to execution related risks, which we think of those as risks that you at least have an opportunity to do something about them, which assists in protecting capital, which I'm delighted to say that with over 11 years of operating history at Star Mountain, we're fortunate to have a 0% realized loss rate on completing over 100 investments. Doesn't mean we haven't had challenges. It means we've been able to work through challenges to date, and we really focus on that. Challenges happen everywhere, big companies, small companies, all sectors. The key is, can you find the risks that if they do happen, you have a fighting chance to do something about them, and you have a specialized business that has the capabilities to address those risks. And that's really what we've built at Star Mountain. So I talked to you about the retiring demographic. I talked about the valuation arbitrage. That just gives you some data to support that. Then at the bottom of the page here, what you can see are a few of the challenges, right? When you look at our returns later and other things, you'll say, well, that sounds great. And when you think about the retiring demographic, the valuation arbitrage, sounds pretty obvious. Well, the challenges are, how do you find these private businesses? They're very time consuming to underwrite them, and you have to have real special expertise to do that. And then managing them. And managing them is really two different aspects. One is managing for risks and challenges should they occur, which of course sometimes they do occur. The other is portfolio management to be a value-added partner, to help these companies grow, to help them maximize value. And that's part of alpha generation, is not just minimizing risk, but it's finding other ways to drive value that are unrelated to market risks. And we have, if other people want to know, we've had different research done and alpha and beta analysis against our portfolio and so forth, which has a very low beta compared to most markets, with quite a high alpha, over 14% net to S&P high yield and other markets. So these are some of the ways we've addressed that. One is we have somebody local in over 20 cities across the country. We have 75 people at Star Mountain, including our operating partners, focused exclusively on the US lower middle markets. That gives a lot of tentacles, a lot of touch points. We built a lot of custom technology to help us better find assets, better evaluate assets, and better manage them, supported by our data team in India, our in-house technology team developing this technology. And we've really taken a long-term approach as a 100% employee-owned company, highly aligned and focused on creating long-term value. We talked about the data of our firm, so I won't get into this in much more detail because we've generally covered this, but these are just a few facts on our firm in one page. So again, we've already mentioned them, so I'm going to keep going here. Team. Team is one of the most critical assets. Yes, we have, in our view, a great business opportunity and segment of the market. We have a specialized firm that we have invested millions of dollars of our own personal capital into building custom tech, building our offices and talent in India for our data teams, and really building a brand with media, trademarking it to have a specialized, high quality, premium brand, premium team to work with high quality business owners to help them manage challenges and achieve their objectives, which there are a lot of. Most often it's via acquisition financing, but there's of course more to it than that, and further professionalizing, institutionalizing their businesses, thinking about when they're going to exit, who's that buyer going to be, what are they going to value, what are they not going to value, to help you make the best informed decisions on where to invest your growth capital, what type of strategic acquisitions to make, what things to integrate and not integrate when you're doing strategic acquisitions. And as you look at the background of my team to do that, I'm very fortunate to have a great team. And I think at the end of the day, it's our team and the culture and the alignment that's our most valuable asset. My partner, Brian Finn, was the president of Credit Suisse First Boston, managing about 18,000 people. He was also the global head of M&A there prior to that, and also the global head of their, at the time, $100 billion alternative asset management business. Our chief risk officer, Dr. Lev Borodovsky, ran global risk for Brian Finn at Credit Suisse Alternatives, and then left with the GSO team that spun out of Credit Suisse, forming GSO, and was their founding chief risk officer as well before joining us approximately 8 years ago. The chairman of our investment committee, Chris Barosak, and our other investment committee member, Mr. Steve Paris, have been investing in private credit and credit markets together and private equity for approximately 30 years, dating back to chemical securities. Some of you may know of the late Jimmy Lee, referenced in Steve Schwartzman's most recent book from Blackstone, and really pioneers of the credit space. And we've taken large market expertise, knowledge, capabilities, and we bring that into a specialized business to address the challenges and opportunities within what we think of as private, established, small and medium-sized businesses. We don't do startups, we're not venture, but we focus on companies that are large enough to be established, and we believe get rid of a lot of the startup-related risk, but not so large where you enter the next type of risk, which is highly competitive capital markets. And we all know of the massive liquidity in the markets, the massive inflows that you see across the market. And if assets are easy to find and quick to underwrite, chances are they're going to be highly competitive. So we've built an engine and a business to really find that. And we've spent a lot of time curating and developing a team, including having partners from large executive recruiting firms that help us in thinking about developing our talent, that are actually partners in our business, not just people that we pay commissions to, which we think is important. Let's talk a little bit about the two strategies that we have. When we built Star Mountain, we really wanted to try to have large market expertise and resources and relationships and knowledge to bring into that market. One of the challenges with the lower middle market, and I had this in the first business when I started my principal investing career in 2004 in the lower middle market, when I left Solomons Barney, where we were an agent buying and selling and evaluating assets on behalf of other people, including internal assets of the firm. So it's a half principal, half agent role, you can think of it as. When we left that in a standalone basis in 2004, we loved the marketplace. We loved the lack of efficiencies, the sophistication and knowledge advantages that we would have that created value. But it was so challenging not to have robust technology capabilities, robust industry expertise, and specialized verticals of people. So when we built Star Mountain, we built it with a view of how do we create the type of resources and the nexus and the collaborative ecosystem that we want without leaving the lower middle market. Because as I'm sure many of you know, you see a lot of asset managers that create great returns and a smaller footprint. They then use that track record to raise much bigger funds, and they use those larger funds to enter a larger marketplace, and the returns drop substantially because in the larger marketplace, it's much more competitive with a lot of great talent. So when we built our business, we really built it saying we want to focus on staying in this end of the market. And so to do that, one of the things that we did is we developed two complementary strategies: one marketplace, one asset class, one technology platform, one origination platform, portfolio management, so forth. But we wanted more people, more resources, and more visibility and more assets. Last year, for example, we originated over $20 billion of direct loans, which was over 1,500 private direct investments, as well as hundreds of millions worth of additional secondary opportunities in evaluating buying assets that way. And that information and knowledge with our custom tech and our ability to enter and access and evaluate that data, we believe provides us with much better insights to ultimately focus on, as you can see at the top, protecting capital, generating yield, and then generating additional alpha and equity upside that is often in the form of a long-term capital gain. Let's talk about relative value for a moment. Absolute value matters and relative value matters. So across our three primary funds and their related separate accounts, this is the performance that we've achieved relative to our benchmarks. You can see with our first fund, private debt median returns were at 7.4, top quartile was 8.7, top decile was 11.5. And as of the benchmark data, which the most recent benchmark data is 3/31 last year, it's 13.8%. We're happy to give people any updated information we have. We just benchmarks, you have to show the data relative to when the benchmark was to ensure that you're providing apples to apples data. And benchmarking usually gets updated with about a 6-month or so lag to the most recent financial information that's reported. So as a firm, we have our 9/30 data, but the benchmarks are still about 2 quarters lagged behind that. A lot of the warrants and the equity upside that we have often matures later with the view of creating additional value. And so as you see our fund 2, it also beats the average, it beats top quartile, it is slightly below top decile. We target and believe that this should increase over time, given the other warrants and other equity value that has not yet materialized and is often valued very little until such time of materialization. As you look to Fund 3, our most recent fund, it's really the story there is it's taking advantage of a marketplace opportunity that we have now where banks have retracted further and there's just a lot of opportunities, and the pandemic has made it really hard for a lot of people. Fortunately for us, it's not like we planned a pandemic, but local matters. Local matters even more in a pandemic when people don't want to be flying. So having boots on the ground in over 20 cities across the country has really created tremendous opportunity for us to remain actively agile in finding investment opportunities, evaluating them, working with business owners, creating relationships, creating strategies with them to help optimize value. And as a result of that, that has so far been our highest value driving vintage, and we're quite excited by that. One of the other things that I think is an interesting call out, I'm sure everybody on this call knows there's been a tremendous inflow of capital to private credit, and that is for sure true. And let's look at some data that shows what happens when markets have massive influxes of capital and when rates go down. The high yield market today is around a 3.5% yield to maturity. So if you look in the far right here, you see the most recent vintage for private debt is 4.4% net compared to nearly a decade ago, it's 7.4. That's a massive drop. So a lot of people say, well, why would people even invest there? Well, it's still a reasonable premium over a 3.5% high yield market. And what you see though with us, where our marketplace is a lot less competitive and is not subject to the massive inflows that the more efficient and easy to access markets have, you can see where that marketplace has dropped a lot, but we really haven't suffered from that. And I think that's important as we think about the world we live in today, where there's really a surplus of capital in many ways. Compliance would be happy, I'm sure, for me to say past results do not guarantee future performance. All of our funds are audited by a top 4 auditing firm, and all of our funds have third-party quarterly valuations by one of the largest valuation firms as well for what it's worth on that front. Let's talk a little bit more about our direct lending strategy. We're not trying to be all things to all people. Our goal is to optimize alpha. And to do that, we've come up with a strategy that's very labor intensive in almost any way you can measure it. And one of the ways of thinking about generating alpha is how do you get paid for something that is not just risk, right? How do you not just have beta, but how do you create alpha? And labor is a good way to do it for an investor. Perhaps not a great way to do it for an asset manager because it means you have to have a lot of people. We have a lot of people per AUM, but we create, knock on wood, and we'll continue to create strong alpha and therefore make money in the back end via our carried interest and our alignment with our own capital invested with our shareholders. And when you think about debt, a lot of people think about passive bank debt because that's what we're most familiar with, whether it's a mortgage or something. You're looking for debt to just say, hey, I want to optimize my return on equity, I want the cheapest, most flexible, passive debt possible. And for some businesses and some solutions, that's a perfect fit. You want to build a new warehouse, get as cheap and flexible of debt as you possibly can. But if you're a private business owner and the average business we invest in has over a 20-year operating history, if you want to make a really tactful strategic acquisition and you've never made an acquisition before, how do you evaluate the business? How do you negotiate the acquisition? How do you structure it? How do you integrate the business, the people, the tech, the customers? How do you do that all the right way? Right? On paper, M&A is easy. But as you see in the large markets with M&A doesn't always create value, meaning there's complexity to it. You can't just buy a business and say, oh, now we're bigger and everything works great. A lot of challenges can come from that. A lot of people can get unhappy. And so you really got to be strategic about how to do it the right way. But if you can create a lot of value. And that's what we're really built to offer. Business owners get to rent our capital, rent our expertise as sort of a one-stop shop solution. And as a result of that, we're not low-cost passive debt. But when business owners think of us relative to selling a whole bunch of equity, which is another way you can get a strategic capital partner, is by selling your business. And in the lower middle market, you often have to sell control to do that. Well, a lot of business owners don't want to sell control. So they prefer to rent us. On average, we're only rented with the duration of our loan for about 3 to 3.5 years. So the absolute cost of us, if you're successful in your business plan, becomes actually quite cheap relative to selling equity. And that's what we like. We like that positive selection bias where a business owner doesn't want to put a lot of debt on their business, but they want a strategic partner to help them execute their plan. So we think of ourselves as being your investment banking partner, plus your consultant, plus your capital provider. For sake of clarity, we're not charging extra fees. It's just that's the type of consultative, value-added relationship and service that we're bringing these private business owners, which our team have ran some of the largest investment banking divisions and firms on Wall Street, and ran also large multi-billion-dollar controlled private equity firms and so forth, and been C-level operating executives, presidents, CFOs, COOs, you name it, of lower middle market private companies. So we have sat in their seats. We've done all the things that the most strategic advisors could do for them, and at levels that they couldn't otherwise access, meaning they can't go hire Goldman Sachs and have their group head work actively with a little $50 million business. That's the type of expertise that we believe we provide to them and is of value. And ultimately, that's where it creates a win for them and us as a different offering. The cost is we're not deploying tens of billions of dollars a year, right? This is a labor-intensive strategy that we do. This year, we'll deploy, we estimate, around $500 million in private loans. So it's a good-sized business, but we're small potatoes and very resource-intensive relative to any large asset management firm that you would all know of. We talked about this earlier. We think of risks in very simple terms. There's lots of risks out there, but two ways of thinking about risk is your startup risks of small businesses, which we avoid, and then the market risks, right? If 100 people want to make the same loan, you're going to have to do quick due diligence, accept low quality covenants, accept lower terms and so forth. And also those bigger companies and businesses owned by large private equity firms, they're not going to pay you for that extra consultative value that Star Mountain brings because they already have it. So we really have built a specialization generally within that 3 to 30 million of EBITDA marketplace, with companies often being around that 10, 15 million of EBITDA, and then we'll help them grow organically, strategically, and via acquisition. One of the things that surprises people when you think of small businesses, you think, oh, gee, do they just fall off a cliff in a downturn? And startups, on average, do. Startups have an extremely high failure rate, which, as we showed, that's not where we invest. But when you get to a business that is established in a lower middle market company, as you can see here from third-party data, these private lower middle market companies grow revenue not only in a less volatile manner, but faster. So if I just asked everybody in this call, which revenue line would you rather lend to? All else equal, which we know the world is not all else equal, it's a multivariable equation, but one important one is if you have revenue, you can work through a lot of challenges. So one of the things that we love in picking the right businesses in this end of the market is that they actually can be, It's not a guarantee, but they can be more resilient and grow faster, which as a lender and an investor, of course, that's a fantastic dynamic. So we like to point this out because it's not what people would think. And if people want later, I can talk about why and what are the drivers behind this factual data. Another thing that is interesting to people is we assume the high yield market, your average yield to maturity as of yesterday, at least in Wall Street Journal, was 3.5%. Not very high. Well, you'd hope that, well, it's safer because it's really big. There's no data that we have ever seen, at least, to support that. And here's data to the contrary. So to the right, you can see research that Standard & Poor's S&P did from 1995 to 2018. Lots of cycles, lots of ups and downs. What they found is that larger companies, larger loans, pardon me, this is specifically loan size is how they did it, had a 3 times higher default rate nearly relative to smaller loans. And you'd say, well, that doesn't make any sense. Why do I get paid a lot less? Market efficiencies. People forget in risk reward about the massive impact housing market, right? I live in Greenwich. You can buy the same house I have in many other parts in this country, I'm sure, for a dramatically lower price. Please don't share that with my wife, but you all know that. Same house, same materials, same amount of land and everything. It's the location, the amount of people that want it, right? At the end of the day, basic laws of supply demand. And for some reason, we all sort of forget that, I think, in investing. And if you look at maybe one of the why drivers behind that factual output is Moody's. So Moody's did a similar report over a similar 25-year period of time. And they said, well, that's nice, S&P. You showed us what happened. Let's talk about predictors. There are a lot of variables that go into risk. But the single largest predictor they found was how much leverage you have on your business. And whether you're Toys R Us or any other large company or a small company, if you have too much debt, that on average is the single highest predictor of you defaulting. Size of company does matter, but it was the smallest variable from a weighting. It only was weighted at 6% of the probability of you defaulting. So size does matter, but it matters a little bit. Amount of leverage matters a lot. And so you can perhaps have a smaller business with a lot less leverage, and that might be less risky than a really big business with way more leverage. And when you look at the data from S&P, it's kind of what it shows, right? Really big companies, people assume they're safer, it's more competitive. They borrow money a lot more, a lot easier, get higher levels of leverage, and lo and behold, that drives a much higher default rate, at least historically speaking. There's no future guarantees, but this again is over a very long period of time. Switching gears a little bit now, we talked about risk and macro things to focus on the right end of the market where we believe one can target alpha easier. Here's kind of a step chart. A lot of people like to see how the cooking is made, how the proverbial sausage is made, where we have upfront closing fees and all fees are passed on to investors, cash interest rate of just under 11% on average, accrued interest, which is due and payable at the maturity of the loan. Our loans generally get repaid early because, again, we're not here for long-term permanent capital. We're here to create value, help business owners strategically grow their business, and then we're okay that they're done with us. And we get another little fee, and then we often will have some equity upside, including via warrants, which is one of the other reasons we don't mind being refinanced out, because we say, great, we now don't have risk with those warrants left as far as dollars at risk, but we have upside, and we want to continue to strategically help you grow your business, which is where the long-term capital gains opportunity comes in. And then less management fees, carried interest. And one of the things a lot of our investors love is that the biggest fee we get is carry performance. Most credit managers, I believe, if you look at the information, you'll often see that the highest cost to you is their management fees, which is often not very performance related. Ours is carry. We can't manage tens of billions of dollars. But if we do our job right and continue to, we can make high returns similar to a private equity approach to life in the form of the carried interest, which is aligned and subordinated to our investors. And this shows you we provide different structures and whatnot that we're happy to tell people about if they'd like, where there's levered, unlevered solutions. And those are just the impacts you can see here with the half a turn of leverage that would net out illustratively to 15.5 with no leverage at all. For sake of clarity, that means not even a capital call facility. I think people often don't count that as leverage. And if it's not leverage, I'm not sure what it is because it's not LP capital and it does make a big difference to IRR. I think a lot of investors are starting to get pretty smart about that now. And with no leverage at all, that's 9.7 net.
Hey, Brett.
Yes.
My apologies. We have another presentation starting at 1.
Perfect. Let me just give you a 2-minute wrap up for you if that works, Michael.
Yeah, that's fine.
Great. This here just shows the distribution of returns. So you can see that it's a high probability of the results being generated versus highly volatile, such as more in the venture capital space. These are the realized returns where you can see a nice right tail skew. To date, we've been fortunate to have a 0% realized loss rate. The secondary business you can see is historically one of the highest Sharpe ratios. So again, alpha focus. You can see here that if you're good in finding the right lower middle market assets, they historically provided the highest returns, but also the lowest returns. So you really have to know how to find them, how to dig. But if you can, there's real opportunity. These are the results we've generated off our secondaries. Similarly, a 0% realized loss rate on that business, which are all at least top quartile, if not top decile across both MOIC and IRR. And that's really it. Let me wrap up and be respectful to the next people. Thank you, Michael. Thank you, Flya.
Brett, thank you very much for doing this. Maybe for the next event, you can come back and, you can continue. I found the information very interesting and insightful. A lot of data. It was rich in data sets, which I've been getting some messages the audience appreciates.
My pleasure. Thank you all. I hope you're safe and would be happy to follow up with anybody on anything. Thank you, Michael and the Flya team.
Thank you, Brett. Thank you very much.